Get right to the floor show. Traders at the New York Stock Exchange, CME Group, and the NYMEX. Guys, I'm here at the NASDAQ. We're looking at some real winners here. But Mark Newman, let me start with you. Nonetheless, when you put it all together, January, at least this one, may be the worst that we've seen in just a couple of years. So spread it out. What do you think really happens here in the next couple of sessions?
Well, it's interesting. It's encouraging to see a little bit of a bounce and a stabilization, and obviously we've seen that in some of the emerging markets, and that's definitely been a benefactor. It's definitely helpful to this market, I think, overall. It's tough to make too much of this because we have seen an excessive amount of volatility. So this is really the new normal, and you can't make much of this rally today. If we get over 1815 in the S&P, you can give it a little bit more credit. It's important that technology is starting to show real signs of outperformance, and particularly ahead of today's Google and Amazon earnings. But tech has been a real standout. We see the NASDAQ back over January lows that were broken, and so the NASDAQ obviously much stronger than the Dow Jones, and that's something to point out. And all the indices really managed to hold December lows, and so that's going to be a critical level of support going forward. And the fact that we just had a short-term correction but really held the longer-term uptrends is a good sign. But I'd mention to your point, this, January is going to be down about 3%. Looking forward, the year obviously should be a lot less robust as a result of that. And a couple different surprises. One is that consumer discretionary, one of the worst performing sectors this month, which was the best of the whole year last year. And so that's obviously fallen out of bed a bit. And we've seen good signs of strength in technology.
Right.
Healthcare continues to be strong. Utilities, though, I would mention also has people scratching their heads as being one of the best sectors so far in January. But some of that can be attributed to the pullback in rates.
And obviously, here at the NASDAQ, they always call it the tech-heavy NASDAQ. Up 81 points. That is a nice percentage gain, Larry Shover. We got some good GDP numbers, as we mentioned. Although we did look at pending home sales, the lowest that we've seen in 2 years. Which one do you believe? Mark's tone is one that says, this rally might not be for real. Well, why not? I mean, what do you see here?
Well, I think it is for real. I think actually this last month was kind of contrived. I mean, first it was the economy's failing, then it was the Fed, and now it's the emerging markets. And the fact is we've had a very good run-up, especially the fourth quarter of 2013. We're due to cool off a little bit. And you're right, the GDP number today was, by and large, very strong. There was definitely a miss on the housing number. We haven't had a whole lot of good housing numbers in the last few months. But all in all, we're still growing. We're just cooling off a little bit. So I just think that this is a good time to just find stocks that are on sale.
Okay, and I'll tell you what's not on sale is crude oil. Crude oil bumping up above $97 for the first time in, I want to say, about 6 weeks. We also have natural gas doing a complete reversal, Tom Riley.
Yeah.
I bring this up because weather is getting a lot warmer here in New York City. It's not as freezing as it was just a day ago. And so the gain that we saw in nat gas of 11% yesterday, we're seeing a slice back of about 8% on that level.
Yeah, you're going to see real volatility continue in that market over the next couple of weeks. It looks like the real cold that we've been going through the last week or two is going to be gone for the foreseeable future. So you're going to see natural gas prices sell off here, although I would look for one more pop before March ends.
Okay, well, I would think so. We've got a few more storms to go. Thanks, gentlemen.